Is India Inc. ready to mind the gap? Hello and welcome to this special series as we cover India Inc.'s journey from Indian GAAP to the new Indian accounting standards. Over the next few weeks, we will examine the key areas of change and analyze the impact on India's top companies. On this first episode, I have with me L&T CFO Shankar Raman and two top auditors, Dolphy D'souza and Jamil Khatri. Gentlemen, to all three of you, a warm welcome to this first episode of this special series. Starting 1st April 2016, 39 new Indian accounting standards, Ind-AS, will apply to all Indian companies with a net worth of 500 crore rupees and more, and to their holding, subsidiary, joint venture and associate companies. Now this applies to listed and unlisted companies, except banks, non-banking financial companies, insurance companies and companies listed on the SME exchanges. Though Ind-AS will apply to standalone and consolidated financial statements, overseas subsidiaries, associates and joint ventures can continue to report in local GAAP, except for consolidation purposes. Starting 1st April 2017, all listed companies and companies with a net worth of 250 crore rupees and more will also have to adopt Ind-AS. All companies adopting Ind-AS will also have to provide comparative numbers for the previous financial year.
In terms of preparation, I think the preparation started right now. In fact, we are required to convert the opening reserves as of 1/4/2015, which is 3 months behind us, and then every quarter keep doing a parallel run on Ind-AS. So I think if people haven't started thinking about it, I think they're already 3.5 months behind schedule.
One thing that we are still unclear about, Menaka, is what happens when you have group structures where you have an intermingling of covered entities and entities that are not covered, which means, for example, corporates such as L&T having a NBFC company. I think that's an issue where there is still lack of clarity. But otherwise what you describe is where we are today.
We have a subsidiary, which is a non-banking finance company, and they are exempt under the current laws. But for the purpose of consolidation,
they will have to prepare.
They need to do it under Ind-AS. And if the subsidiary happens to be a listed company, which is the case in our case, there's enough confusion. The listed company will prepare and present its financial statements based on the current
Indian GAAP.
And the consolidated financials will have the non-banking business as a segment, but compiled under Ind-AS. So you're going to have for a same business two outcomes as presented by the ultimate parent and by the listed subsidiary. And this is going to call in for reconciliation, which sometimes can be tedious and could lead people to wrong conclusions if they don't take care to do the reconciliation appropriately.
This could create a huge implementation issue, particularly when the NBFC is on the top of the structure, because the companies underneath the NBFC may have all followed Ind-AS, but there is no early adoption.
Can you give me an illustration of what kind of group would get impacted by this?
Let's say maybe Tata Sons, for example, where the top entities in NBFC, but the companies underneath are all following Ind-AS. And therefore this NBFC company will need the underlying company to prepare Indian GAAP accounts, because the NBFC company is not allowed to follow Ind-AS early.
Fair enough.
So therefore I think the laws will need to change, and this is an unfinished agenda, so the government may need to give an exemption to these NBFC companies from preparing a consolidated account.
I think these challenges will be there, and I think we'll have to bite the bullet on some of this. So as RSR said earlier, it is even if you have overseas subsidiaries, you have to go to dual reporting where they do what is local GAAP for them, and then for reporting for consolidation they do Ind-AS that you follow. I think that's the model we'll have to follow here. There is no other way, because to expect NBFCs to jump in and do it at the same time as the corporate world will throw up many challenges on capital adequacy, which is not desirable. On the other hand, to defer everybody, because some NBFCs have to have a deferred guideline, I think therefore this is going to be, and that is where the role of communication, of creating awareness on what is the difference between what you do for consolidation versus what entities do for regulation is going to be important.
An elegant way to deal with that perhaps in the interim is to exempt the ultimate parent company, which has a non-banking finance company as a subsidiary, to convert the non-banking finance company's financials into Ind-AS.
But won't that impact your consolidated numbers? Because in your consolidated numbers, you'll have one little segment which is in fact not adhering to the same accounting standards as the rest of your consolidated.
In my opinion, I think it will have homogeneity in the way they present and the way it is seen in the parent. It could possibly be a little more clearer as to the final outcome of the operations as compared to having two different sets of numbers. It can be very different. For example, if you talk about provisioning for non-performing assets, there is an estimated loss principle that comes in the Ind-AS, whereas in the financial services business it goes on rule application. If the overdues are beyond 150 days, beyond 180 days, beyond 90 days, and whatever the Reserve Bank of India's regulations are.
Right.
So you're going to have for the same asset, with the same asset quality, represented as inferior in one set and superior in
the
another
other set.
And that doesn't actually give any kind of clarity to the readers.
But could it be in a group where you'd have a subsidiary that ought to be exempt, as you have just pointed out, so that in the reported numbers there is no confusion, but other subsidiaries that are not exempt, which may have similar processes and are accounting as per Indian accounting standards? So could it be that in one consolidated balance sheet, a particular type of business item is reported in Ind-AS, and because of the exemption, the other similar business item is reported under, sort of the current Indian GAAP in that sense, leading to even more confusion in that sense?
It is possible, Menaka, because a non-NBFC subsidiary or a non-NBFC parent itself could have loans which would be subject to impairment. I think the point is, this is a challenge. Whichever way we go, there should be clarity, so that we can apply our minds and do it the right way.
Where will that clarity come from?
That has to come as we move closer to implementation from the Ministry of Corporate Affairs and the RBI working together to really say how do they expect this to be reflected in the consolidated financial statements.
What is the best practical solution to this?
I would say align the dates.
Well, that's the most difficult political one, I imagine. So that one, and to add to the confusion, there is some trouble about whether housing finance companies are categorized as NBFCs or not, and therefore are they exempt from the April 1st deadline or not?
That is correct, because the current exemption is for NBFCs, banks and insurance companies, and housing finance companies technically are not governed by the RBI but a separate regulator. We are aware that many housing finance companies have reached out to the regulator to confirm that they would not be covered. That's a matter of time. I think that clarification will come. We need to be conscious about that. I just want to add one point, Menaka. The problem with bringing forward a date for NBFCs is that the Ind-AS that we have implemented or are seeking to implement on financial instruments and provisioning is in fact a standard which has not been tested anywhere globally as of now, because we are following the new model, and therefore that was one of the reasons behind the thinking that the RBI had to say why we should not bring that in today, but really
let the global standard be tested
implementation
and then
happen.
applied.
And therefore I think we will have a lot more resistance, a lot more kind of confusion if we do that. But I think all of what we've kind of talked about are things that the regulators need to clarify.
Up next, the impact of Ind-AS on consolidation, revenue recognition, combinations, financial instruments, and much more.
I want to look at some of the key areas of impact. So how does this impact play out? First and most importantly, the question investors will be asking is, will this impact revenue? Will this impact bottom line? Will this impact financial ratios? To determine that, I understand we need to look at the impact on 5 or 7 key areas. For instance, consolidation.
This is a very important development, Menaka, particularly in the area of de-facto control. And I'll give you a simple example. Let's say a company has 40% stake in another company. So under Indian GAAP, we do not consolidate this company because it does not hold a controlling power. But under Ind-AS, there is a concept called de facto control. So with 40% holding, you may still have to consolidate the company, which is otherwise shown as an associate under Indian GAAP. The argument being that if, let's say, the 60%, the remaining 60% is widely held, then through 40% you are able to control the other company. So if in an AGM 75% shareholders attend the AGM, 40 on 75% is 40 on 75 is greater than 50%, and therefore in substance you control the company, and therefore you will have to consolidate the company. So we see this in quite a few groups where several group companies hold 40-45% share in another company, and then that company is not consolidated under Indian GAAP but will have to be consolidated under Ind-AS.
I think conversely the other situation also holds good, which is if a company holds more than 50%, but the minority shareholders have rights which are called veto rights. So let's say the insurance sector in India, many Indian groups hold 74% in their insurance subsidiaries. The foreign investors own 26%. Today these entities are accounted for as subsidiaries. Top line is included, EBITDA is included. Going forward, because these foreign shareholders, strategic shareholders, have rights to participate in the business plan, appoint key managerial personnel, the Indian shareholder, despite having 74%, would not be able to consolidate. So I think there are entities which were not consolidated earlier which will come in, the de facto control, and entities which you treated as subsidiaries which will no longer be treated as subsidiaries but only treated as associates. A related issue, which is an important concept, is earlier if something was jointly controlled, in the insurance company example I gave, you did what was called proportionate consolidation. So you would take 74% of the top line, 74% of the cost and the profits. Today the entire P&L will change under Ind-AS, because all you're entitled to is to pick up 74% of the profits. So EPS will be okay, but your EBITDA will change. Now think of that in a sector like telecom, where the business is valued on EBITDA multiples, and you have these tower companies which are held in using the structure that I defined. Suddenly your EBITDA falls by 10-15%. Market is valuing you on a multiple of EBITDA, and you got to create awareness that your business has not changed. I think that's a big issue.
Will the L&T group get bigger or smaller?
Ventures, from joint ventures perspective, I think we today have the benefit of reporting consolidated proportionate revenues. So those would disappear, but it all depends on whether in a particular year there are more of joint ventures, because these are very project specific developments. So it depends. If more and more projects we are going to bid on our own, then this wouldn't obviously affect.
Let me get to the other area, which is going to be another big area of change, and that is revenue recognition.
I think on revenue recognition it will be very sector specific. Wherever there are companies who have a model of collecting upfront fees or upfront collection from customers which do not commensurate to services being provided. Today the concept that many companies follow is that non-refundable cash or a milestone is revenues, while under Ind-AS you got to correlate the activity, the benefit to the customer, and then recognize revenues accordingly. So we see there could be instances on deferral of revenues. For many entities it may not be significant, but there are sectors which could be impacted. For example, we know of companies which are in the holiday home business, who have a particular revenue recognition practice. They follow practices which are acceptable today, match cost and revenues no longer. So I think it will be very sector specific.
Real estate sector, for example, today the current Indian GAAP permits you to recognize revenue once you reach 25% completion and 10% of the payments come through. Now today that is being set aside under Ind-AS. The trigger is what is enforceable contract that you enter. So if you give an allotment letter of an apartment under construction, you can very well start recognizing revenue early on. It's all a question of how enforceable the document is.
So are we going to see revenues increase, decrease? How does an investor understand this?
In a lot of cases it would actually decrease. So for example, things like rebates and coupons, slotting fees, gifts, those are shown as cost under Indian GAAP. They would reduce revenue under Ind-AS. I'll give you a simple example. Let's say a real estate company sells you a house and gives you a car, free car for the real estate that you have bought. Today they will show that as a cost, but going ahead under Ind-AS, that will have to be reduced from revenue.
Sales practices could change as well. If you provide extended credit than what is normally done, then the value attributable to the period of credit is taken in as an income earnings out of interest rather than sales. Today it's all packaged in one number as sales. So there is going to be a segregation of what is true sale and what is the value of credit embedded in the sale.
This will cut across several industries.
Yes.
Several consumer-facing industries will face
Absolutely.
this, auto, etc. I mean, a variety of them
Absolutely.
will face the change.
And these are the companies which are measured on market share on top line.
I want to give another dimension to this on where revenues could go up and what's the implication of that. We're
That's
having
good news.
some
Yes,
good
please.
discussion. Actually, that's not necessarily good news, as you'll see. So let's take a telco again. And when a telco sells a prepaid connection and you buy a prepaid connection from a shopkeeper, today and let's say you pay 100 rupees to the shopkeeper passes on 95 to the telco. Today most telcos recognize 95 as revenues, and the implication of this is license fee that they pay to the government of India, which, as you know, is a matter of litigation. Ind-AS said that ultimately when I as a customer buy that prepaid connection, I am looking at the telco as the service provider. So the revenues for the telco are 100 and not 95, and 5 is the commission that is passed on to the dealership.
So you have to book 100 and then pay your license fees on 100.
And that's where the license fee debate comes in.
Okay, fair enough. Third area of impact, combination.
Yeah, I think it's very important that when you enter into a business combination, you understand the contours of the deal. So for example, if you're acquiring a company and you have a contingent consideration that you are going to pay to the promoters based on the future revenue or EPS, and the structuring of the deal is that those promoters have to continue in employment, then that contingent consideration that you're going to pay to the promoters would be your compensation cost, which will hit your P&L account in the future.
Okay.
But if there was no need for those promoters to continue, then that would have been treated as a consideration which really impacts your goodwill, not your future P&L account. So it's very important to understand some of these aspects when you actually enter into a business combination deal.
Yeah, I think the two areas where we're seeing the most impact is earlier, accounting for acquisitions or mergers was also dependent on what you could get the court scheme to tell you.
Yeah.
It was based upon how you structure the arrangement. Is it really a merger? Is it a consolidation? Is it a slump sale? Going forward, everything will be based on one simple method: what you pay versus the fair value of what you acquire. You acquire a lot of intangibles, they will hit your P&L and will be EPS dilutive, and the balance is goodwill. So in a way, it's more consistent, it's driven more by the substance than the form.
I think most of the decisions on these mergers, acquisitions are based on the value creation potential. And value is relative. It lies in the eyes of the beholder. So if the accounting statements are going to take in the amortized cost, which is larger than the normal traditional depreciation, the accretion to earnings changes.
Right.
And on top of it, if you're going to have soft loans given post consolidation, the soft loans have to be fair valued as well, and there's going to be the benefit and the cost implication for the provider and the receiver. So the whole economics of mergers will have to be recast, and then possibly the final outcome needs to be evaluated.
Okay, fair enough. Financial instruments, that's going to be another big area of change.
I think there are many areas, Menaka, but one particularly which I believe is not being appreciated a lot is put options. And I say this in the context of, let's take the real estate sector, where a lot of transactions where private equity came in, they came in with put options,
Right.
And they were treated as sale of minority interest. Profits were recognized on those sales. They're treated as equity holders.
Now it's all debt.
But it is all debt, and I think we are going to see a lot of unreported debt, whether it was because it was issued in the form of redeemable preference shares or equity shares with put options. I'm really worried about the quantum of that debt coming back into corporate balance sheet.
I would say foreign currency convertible bonds, because today what you do under Indian GAAP is you capitalize foreign exchange difference, or you amortize it over a period of time. But under Ind-AS, you will have to charge those foreign exchange differences to the P&L account. Similarly, the premium that you pay on the foreign currency convertible bond, it's adjusted against security premium under Indian GAAP, but you may not be able to do that under the Ind-AS, so your charge in your P&L account and your EPS will take a big hit on account of a foreign currency convertible bond. On the positive side, I would say things like perpetual bond, where you have an economic compulsion to pay, but you don't have a contractual liability to pay. In that case, you would treat that as an equity in your books, and what you pay to the perpetual bond holders would be a appropriation to equity holders akin to dividend rather than an interest expense.
Okay.
So that's on the good positive side.
There are structured instruments where there is a hefty premium on redemption, and the redemption payment gets charged to the reserve, security reserve, and the lower coupon gets accounted through as period cost. Today Ind-AS tends to correct that, and I think what the investors will get to see is the true cost of that debt obligation.
Okay, I have 3 more impact areas and I want to go through them very quickly to give our viewers a sense of what the implications are. For instance, what Indian accounting standards or IFRS and its parentage attempts to do is fair value. How would you describe the impact of this big conceptual shift on, let's say, individual items, if any?
I mean, let's take an example on fair valuation. So for example, under Ind-AS 109, if you have, let's say, equity investments in a company, and we see that very often in, let's say, media companies, where they do a lot of work for startup entities and they do not get cash. What they get is equity shares. Now those equity shares will have to be fair valued either through P&L account or OCI through an option. And fair valuing those kind of shares or non-cash consideration is going to be amazing amount of work. And particularly if it's a startup company, how do you fair value these startup companies? It's going to be very difficult.
Jamil, disclosures?
Yeah,
extensive?
Extensive. And I think what we really found people struggling with is sensitivity analysis, particularly.
What does that even mean?
So on foreign exchange, for example, that if you have a forward contracts or if you have foreign currency borrowing, what would a movement of a particular percentage in exchange rate means to your earnings? Those kind of disclosures now come in the notes to the financial statement, and in a way this is showing the investor what could go wrong with the company with the exposure it is sitting on right now.
Mr. Shankar Raman, final issue of key area of impact, and that is taxation. I know we now have the introduction of ICDS as well. How will you reconcile the move to Ind-AS, the implementation of ICDS, and therefore the effective impact on taxes?
Indian taxpayer has been conditioned well for long. I think we've always battled with a different set of numbers when it comes to reported financials and different set of numbers when we sit in front of the tax officials. So I think the fundamental need to reconcile has been well understood, established. The way I see ICDS is it's formalizing the practices that is currently being done for estimating the revenue and the taxable income, except with specific carve-outs on issues which were contentious in the past. It has potential to either increase the litigation or kill it, but we'll have to see how it pans out. It all depends on how the administration approaches it. For example, if you have typically in a contractual company where you have claims, extra claims on the customer, convention, the prudent convention was to account for these claims only when they are either acknowledged as payable by the customer or paid. Now today the income tax official under ICDS can use reasonable certainty as a measure to recognize income which prudent accounting may not recognize. So there is going to be an element of notional income which is taxable, which creeps in. Ultimately tax might have to be paid when the customer pays for this, but that could be very well in another year. So to that extent, I think these are carve-outs which enables government to collect a little more tax than what they otherwise would have done under the current.
Well, what's new with that? Mr. Shankar Raman, you pointed out several areas where the financial changes will also change business practices, right? So you spoke of the economics of mergers, you spoke of sales practices that could change. Supply chains, right, will also have an impact. Financing, we've touched upon this. I want the corporate point of view. Will the tail wag the dog, as Jamil puts it? So will several corporate operational and strategic decisions also change because of the financial changes?
Time will tell. Time will tell. It's a little too early to really predict the final outcome. But as I see, there are critical parts of the supply chain where there are contractual obligations by which the principal employer substantially finances the vendor to make sure that the quality standards are met, delivery schedules are met. They, by current Ind-AS, becomes consolidatable entity because you actually take decisions which impact the result of that vendor. So in such of those contracting arrangements, I think special care needs to go as to whether do you really want to consolidate those entities into your finances. So to that extent, strategy on sourcing and enabling sources is going to undergo some review. It won't be as automatic as it used to be in the past.
In addition to what RSR said, I think there are some other, for example, ESOPs. ESOPs are attractive today because you don't see a cost. We know many organizations reassessing whether ESOPs are the right way to compensate employees once the full cost comes in. So that's an area. I talked about financing and put options with private equity players.
So broadly, the impact when it comes to a business ops and strategic point of view will be on financing instruments, on supply chain, maybe the way you look at M&A or inorganic activity. Any other areas that you see a collateral impact play out?
Yeah, so let's say a power plant housed in a particular company is exclusively providing power to a particular entity, in which case that power plant would be, it would be said that the power plant is actually providing not a service, but the power plant in effect, in substance, is leased to the other entity. And therefore, what will happen on the balance sheet is rather than showing that power plant as a fixed asset, you would show it as a finance lease receivable. And if this plant has a plan to go for an IPO, that whole thing would collapse if you're going to change it from fixed asset to a lease receivable. And those are some of the damages that could happen on account of Ind-AS.
So would you put this in the bucket of contractual changes in that sense?
Absolutely.
Yeah, okay. Mr. Shankar Raman, how are you managing this transition? What are the top 5 things you've laid out for your team to cover in the 8-9 months to come?
We're working longer than usual. We've commissioned a team which is PAN company, PAN group in fact, to see how we need to tweak our IT systems. How do we have common understanding of the interpretations of those several provisions, and how to lace it with our existing accounting policies. So there is engagement with the accountants in the company. There is concurrent engagement with the auditors, because ultimately the numbers and the policies will have to pass the test of audit. And we've not yet taken up the external communication, which would happen once internally we're all bought onto the same page. Communicating the performance to the management is another major area.
Management, audit committees, board committees, and then eventually investors. Absolutely.
So I think this is going to be a huge communication exercise, and my sense, it would possibly run through 1 or 2 years before there is common understanding of how these things are reflected across the board. So it's going to be a lot of grind work for the next 12 to 18 months.
The promise of IFRS and therefore Indian accounting standards was a truer and fairer picture of the financials of a company. Is that really going to come through? Is that what we're going to achieve at the end of this exercise?
Yeah, I think you raise a very, very good question. I'll caveat my last answer by saying that if what you are telling the investors in terms of your business has been true all along and they knew it, and I think, but you will see many cases that when you try to explain this, they will know things which they did not know earlier, and that is better disclosure. I think if we achieve that objective of telling people the way it actually is, I think we would have achieved our objective.
Gentlemen, thank you very much for this fairly in-depth overview.
Next week on Mind the Gap, we discuss how Ind-AS will impact the consolidation of group entities.
Stay tuned to this special series. Thank you very much for watching.